Hello, this is the fourth video in our series on income inequality. In this video, we're looking at trends in income data in relation to the middle class, specifically statements made by Donald Trump and Justin Trudeau that the middle class is in a state of decline and in need of fixing. Why does it matter when politicians make statements like this? Because, from an economic perspective, a healthy, vibrant, growing middle class is essential for maintaining a strong economy. If the middle class, a key component for measuring social and economic well-being, is stagnating or in decline, it's a signal to policymakers that barriers, such as outsourcing or increased demand for highly skilled workers, are preventing individuals at the lower end of the income spectrum from getting ahead. Effectively, this kind of damper on economic growth can contribute to increased social and political disruption. So who are the middle class? From a statistical perspective, following the lead of the IMF, this video considers the middle class to be 50 to 150% of median income. And since resources are shared within families or households, the focus is really on adjusted after-tax income. In the context of this video, what you need to know is, when we talk about direct taxes, we're referring to personal income taxes, but employment insurance and CPP contributions are also included. When we talk about direct transfers, this includes income support payments, employment insurance benefits, old age security and guaranteed income supplement for seniors, CPP pension benefits, and as of July 1st, 2016, the Canada Child Benefit. In terms of a timeline, we're going to compare data for Newfoundland and Labrador in the years 2000, at the start of this century, to 2014, which is the latest year for which data are available. We're also going to look at the data from the perspective of population shares, proportions of the population as a whole, as opposed to counts for individuals or households or families. We're going to cross-reference those shares with income groups in relation to the median. This way, we can easily see how the distribution of our lower, middle, and upper-class population changes as we look at the data for various income measures such as wage, employment, market, total, and after-tax. So what exactly is hollowing out? Well, if we take the claim to be true that the middle class is indeed being hollowed out, then income measures for our middle class should show the population share decreasing from one period to the next, so that displaced individuals from the middle class population bump into either the lower or upper class. Given most income comes from wages and salaries earned over a lifetime, we're going to start by looking at wage data, which is essentially money paid to individuals by an employer. As you can see here, wage income data for the province does not support a hollowing out hypothesis, since the share of population for the middle class has actually risen by 2.4%. For Newfoundland and Labrador, there are relatively large numbers of self-employed individuals, and in some cases, self-employment income may actually exceed other sources of family income. So let's have a look at employment data, which includes income from wages, salaries, and self-employment, which, as in the case of Donald Trump phenomenon, can lead to negative incomes because of the ability to write off business expenses. What the data shows here is that population shares for the middle class still show an increase over time. Now, if we look at market data for individuals, which encompasses all sources of income, including capital gains and losses, dividends, interest, and rentals, you can see, even though we are looking at an even broader source of earned income, the middle class population shares are still rising. But what if we look at the province's population from an economic well-being perspective? What happens to the middle class after we pool the individual family member incomes, regardless whether that income was earned or received via government transfer? After we pay our taxes and after we've adjusted the total income based on family size so that everyone in the population is assigned an adjusted family total income amount. Now you actually see potential evidence of hollowing out. Here, in comparison to the middle class of the previous income measures, you can see a significant drop from 54% to 49%. Interestingly, if you also look at the lower and upper income class, you can see that almost all those displaced individuals have dropped back into the lower class, which rose by 4.6%. Looking at adjusted after-tax income, you can see there's a similar pattern of shift in population shares, suggesting hollowing out has occurred over time. Also notice the hill for adjusted after-tax income is much larger than it was before taxes were paid. The key read here is not that the tax and transfer system create the middle class, but rather what you want to focus on is that they work together to reduce income inequality, effectively creating a stronger middle class. So let's have a look and see where the distributional changes lie in going from 2000 to 2014. And looking at the chart, you can see the mode has shifted leftward, but still within the boundaries of our middle class. There are fewer very poor. What's important to note, though, is that everyone is better off. Even when adjusted for inflation, in constant 2014 dollars, there is still a 46% increase, meaning families can buy more goods and services in 2014 than they could in 2000. In the first video, we introduced the Gini coefficient to gauge income inequality, but one of the criticisms of that measure is that it doesn't speak to the distribution at the extreme endpoints, which begs the question, how far apart are the very rich from the very poor? In this slide, then, we're going to look at the Foster-Wolfson Polarization Index, which looks over the entire distribution relative to the median. Similar to the Gini, the polarization index range is between 0 and 1. 0 indicates there's no polarization, everyone has the same income, and 1 represents income inequality, that is, increasing polarization. The chart here, adapted from an IMF working paper, is based on adjusted household income and shows polarization is much more of a problem in the U.S. than in Newfoundland and Labrador. Income inequality was never as great over this period in Newfoundland and Labrador as it was and is in the U.S. But as the next bit of data shows, polarization can be expected to grow here in the province. The table here shows increasing polarization in the adjusted disposable family income. Generally speaking, it can be attributed to demographics, changing economy, or taxes and transfers. However, by setting 2010 as a base, holding economic and demographic factors such as population, family size to 2010 levels, we can focus on change more directly related to taxes and transfers. The result shows that part of the increasing polarization is due to the tax transfer system. But what if you want to look at true purchasing power? How does polarization change for income after commodity taxes, such as the federal goods and services tax, and provincial taxes, such as gasoline or tobacco tax, are removed from income? Calculated results show polarization is a little bit higher than for disposable income and that they are also on the rise. And if the disposable and consumable incomes are adjusted for the household and for inflation in 2016, then the calculation estimates the two income measures will exhibit similar trends, maintaining the relative level of difference, increase in 2015 over the 2014 measure, and then in 2016 dipping below their 2014 number. So from the data we looked at so far, which includes most of what we looked at here, but also some additional analysis, which we'll explore more in upcoming videos, there is evidence that some slight hollowing out of the middle class, real, after tax, and adjusted for family size incomes, has occurred in Newfoundland and Labrador in the 2000 to 2014 period. And this is supported by calculations using the Wolfson-Foster Polarization Index. On a good note, though, we observe the degree of polarization and hollowing out is far less in Newfoundland and Labrador than in the USA, and that adjusted real disposable incomes have risen about 46% during the 2000 to 2014 period. Surprisingly, this hollowing out in the province was not due to labor market forces, such as outsourcing or increased demand for highly skilled workers. Rather, it's partially due to federal and provincial government policies over that period, as well as demographic factors such as household size. And while taxes and transfers over the period significantly increased the proportion of the population in the middle class, the impact in 2014 was far less than in 2000. Additionally, we've seen that polarization is greater amongst women's paid employment income than men's. Further simulation modeling seems to indicate that current government policies should reduce the level of polarization. While current disposable and consumable incomes are increasing, they are doing so at a decreasing rate. When you look at these income measures in real terms, accounting for inflation in 2016, incomes have been falling over the last few years. Simulation also suggests the incomes will continue to decrease over the next few years. So that's it for our discussion on hollowing out in Newfoundland and Labrador. In upcoming videos on investigating income inequality, we'll be exploring some of the following topics. Who are the net contributors and net recipients to the public sector? Average tax contributions by age. The poor, who are they? And impacts of the 2017 budget on families. That's it for now. Thank you for watching.